19 to February 2020. For the first time in the history of Indian stock market, the lower circuit breaker got triggered on two occasions within a short time span of 2 weeks during March 2020. To curb volatility and to ensure orderly functioning of the market, SEBI took several surveillance measures in March, which are still in force. This, along with various measures taken by the government and RBI, brought calmness in the market. The volatility index has now come down and it's around 20. The good news is that despite uncertain times, the overall fundraising through the capital markets during this financial year has been quite encouraging. The overall funds raised up till 18th September 2020 were rupees 5 lakh crore. That is 1.46 lakh crore in equity and 3.5 lakh crore in debt securities. As a comparison with the last year till end August, total funds raised this year were about rupees 4.5 lakh crore as compared to rupees 4 lakh crore last year. This is particularly important since corporate India needed to build a cushion of capital to absorb the COVID shock, and the markets have lent full support to help them do that. As for the performance of mutual fund industry is concerned, overall the industry has weathered the storm well, which demonstrates the robustness of the regulatory framework as well as the maturity of the industry. The mutual fund industry, however, also went through several patches of challenges, especially on the debt mutual fund side. Some of the issues that arose during the period are now addressed, and some are in the process of being addressed. The contemplated policy measures inter alia include stress testing, minimum asset allocation of liquid assets, and a swing pricing like mechanism. Such events also force us to think if there is a need for some structural changes in the system. In this context, I would like to touch upon two recent initiatives taken by SEBI. That is for setting up a special purpose clearing corporation for repo in corporate bonds and for setting up a backstop facility for improving liquidity in the secondary market for corporate bonds, particularly during periods when liquidity tends to dry up. You being a critical part of this industry and the ecosystem have been giving many constructive suggestions on the same, and we look forward to your playing a central role in making these initiatives take root and become successful. Now, coming to the industry performance, if one looks at the track record of the industry, that is mutual fund industry, their growth in the last 5 years, one can easily say that industry has shown robust growth. From March 2015 to August 2020, the asset under management of the industry has grown by 154% from rupees 10.83 lakh crore to rupees 27.49 lakh crore. During this period, while the AUM of debt schemes increased from rupees 6.94 lakh crore to rupees 13.89 lakh crore, AUM of non-debt schemes increased from rupees 3.89 lakh crore to rupees 13.6 lakh crore. The number of mutual fund folios increased by 122% from 4.17 crore to 9.26 crore during the same period. At an industry level, there has been net positive inflow of funds in mutual funds during each of the previous 5 financial years, averaging at rupees 1.89 lakh crore each year. The figure for this financial year till August 2020 is rupees 1.99 lakh crore. To increase penetration of mutual funds beyond top cities, SEBI started incentivizing mutual fund investments from beyond top 15 cities and later from top 30 cities. However, the share of these beyond 15 or beyond 30 cities in the total industry AUM has hovered around just 15 to 17% over the last 5 years. We need to clearly strive more to make mutual funds popular in areas beyond top 50 cities in the country. In terms of the scheme performance, SEBI had introduced the concept of benchmarking to total return indices to bring greater transparency in respect of in respect of how well various schemes have performed, we look forward to the industry working hard to outperform relative to these benchmarks to deliver value to its investors. Now, coming to some of the policy initiatives during the recent period. Liquid schemes of mutual funds account for a very large proportion of all debt-oriented schemes. To enhance the risk management framework for liquid schemes, they were mandated to hold at least 20% of the AUM and liquid assets such as cash, government securities, T-bills, and repo on government securities. The valuation of debt and money market instruments is now done fully on market basis instead of amortization. Further, liquid and overnight schemes are not permitted to invest in short-term deposits, debt, or money market instruments having structured obligations or credit enhancements. Prudential norms governing investments in debt and money market instruments were also changed. Mutual fund schemes have been mandated to invest primarily in listed debt securities, including commercial papers, which is being implemented in a phased manner. All investments in equity shares by mutual fund schemes shall only be made in listed or to be listed equity shares. The cap on sectoral limit, the cap on sectoral limit of 25% has been reduced to 20%. Potential limit on total investment by a mutual fund scheme in debt and money market instruments having credit enhancements is prescribed at 10%, and investment by a mutual fund scheme in such debt securities of a particular group has been capped at 5%. Investment in debt instruments having credit enhancements backed by equity shares, directly or indirectly, shall have a minimum cover of 4 times considering the market value of such shares. AMCs have been mandated to undertake internal credit risk assessment on a continuous basis and also need to be well equipped to generate early warning signals on deterioration of credit profile of the issuer. All AMCs shall publish on their respective website a list of their group companies and those of their sponsors. Valuation of money market and debt securities being an important aspect, SEBI has advised the industry to align with best practices. Some of these alignments include updating the definition of non-traded money market and debt securities and modifying the provision of valuation of money market and debt securities with both put and call options. Further, in order to bring uniformity and consistency in valuation, a waterfall approach for valuation of money market and debt securities has been adopted by the industry through valuation agencies appointed by it. Considering that, as per principles of fair valuation, AMCs are responsible for ensuring fairness of valuation and correct NAV, AMCs are permitted to deviate from the valuation price given by the valuation agencies subject to appropriate documentation of rationale and disclosures. For facilitating price discovery in a transparent manner and improving liquidity in corporate bonds market, SEBI has mandated that at least 10% of mutual funds' total secondary market trades in corporate bonds need to be done by placing quotes through one-to-many mode on the request for quote platform of stock exchanges. Further, all transactions in corporate bonds and commercial papers wherein mutual funds are on both sides of the trade shall be executed through RFQ platform of stock exchanges in a one-to-one or one-to-many mode. Now let me dwell upon the challenges faced by the industry on debt mutual fund side and how those challenges are being addressed. In March-April 2020, significant risk aversion and subsequent illiquidity was observed in the bond market, especially in AA and below rated papers. This created significant challenges in the form of redemption pressures being faced by the debt mutual funds on account of not only normal year-end redemptions, but COVID-related redemption pressures. That experience brought to fore not only the structural issues related to the corporate bond markets, but also revealed some areas of improvement aspect of the practices followed in the mutual fund industry. SEBI has followed a multi-pronged approach to address these issues. On one side, while SEBI has made and is deliberating policy changes to address the areas of improvement in the mutual fund industry, on the other side, it has initiated structural reforms to elevate the problem of illiquidity in corporate bond market, especially in non-AAA rated papers. One of the areas of improvement is to enhance the liquidity of the portfolio of open-ended debt mutual fund schemes. While portfolios of equity-oriented schemes are fairly liquid, same may not be the case with all debt-oriented schemes. While overnight schemes are primarily invested in liquid assets such as G-Secs, T-bills, repo in G-Sec and cash, and there is a provision for liquid schemes to hold minimum 20% in liquid assets, the other debt-oriented schemes currently have no such requirement and can invest in various categories of corporate bonds, CPs, CDs, whose secondary markets may not have enough liquidity. Recently, during the period of increased illiquidity in the corporate bond market, there were requests from the debt mutual funds to permit them to include G-Secs and T-bills in core asset allocation of credit risk funds, corporate debt funds, and banking and PSU debt funds to meet the heightened redemption requests. While the same were allowed as a temporary measure, SEBI is facilitating the setting up of an expert committee to frame a stress testing methodology encompassing liquidity, credit, and market risks for all open-ended debt-oriented mutual fund schemes, and to design a framework to determine the minimum asset allocation required in liquid assets, taking into account the nature of schemes, assets, type of investors, outcome of stress testing, minimum redemption requirement during gating, etc. In the interim, taking into account the recommendations made by the Mutual Fund Advisory Committee, SEBI would be stipulating a minimum holding of liquid assets by all debt-oriented schemes. Another issue that got highlighted was the possible impact of large redemptions on remaining unit holders of a scheme. In case of any scheme witnessing large redemption requests, and with not so liquid instruments as assets, there are high chances that more liquid assets get liquidated first, and the scheme is then progressively left with a relatively more illiquid portfolio. This benefits exiting investors at the cost of those who continue to stay, particularly in case of stressed situations. The proposed expert committee would also examine liquidity risk management tools such as swing pricing or anti-dilution levy for passing on transaction costs to the transacting investors. The tools would apply to both the incoming and outgoing investors, thereby protecting the interest of existing investors. Now, coming to the related issue of tackling illiquidity in corporate bond markets. Mutual funds, as institutional investors, are one of the largest holders of corporate bonds. Mutual funds constantly see inflows and outflows too from schemes. Therefore, mutual funds also contribute a significant share in the secondary market trading in corporate bonds and commercial papers. But under many scenarios, when there are industry-wide trends of subscriptions or redemptions, it becomes difficult for mutual funds to get a sizable counterparty to cater to their buying or selling needs. Thus, there is a pressing need to increase liquidity in the corporate bond market to ensure smooth functioning of debt mutual funds. Apart from mandating mutual funds to do a minimum percentage of their secondary market trades in corporate bonds on the RFQ platform of stock exchanges, SEBI is pursuing a multitude of measures to not only increase liquidity in secondary markets, but also to enable greater issuances of paper rated below AAA. Some of the measures include: the first measure is repo in corporate bonds. On the subject of repo in corporate bonds, a liquid repo market using corporate bond collateral has the potential to greatly enhance demand for corporate bonds, as well as secondary market liquidity in corporate bonds, as many investors who do not consider corporate bonds due to their illiquidity could have access to low-cost funds collateralized by their corporate bond holdings. Market makers in corporate bonds needing access to low cost capital as well as securities to cover their short sales would also be able to carry out their market making operations more cost efficiently in the presence of liquid repo market in corporate bonds. As per the latest European repo market survey of International Capital Market Association, in December 2019, corporate bonds as a collateral had a 17.3 share in the total euro 8.3 trillion outstanding repo contracts in the books of 58 participating institutions. In India, the repo market in corporate bonds has unfortunately not taken off till now. SEBI is deliberating on having a limited purpose central clearing corporation for guaranteed settlement of triparty repo trades in all investment grade corporate bonds, including those below AAA rated, to boost repo trading in corporate bonds. As major holders of corporate bonds, the mutual funds who regularly have buying or selling needs would be one of the biggest beneficiaries of a liquid market. Issuers will also be significant beneficiaries of a liquid and stable market in terms of lower borrowing costs. The second initiative is setting up of a backstop facility. Now, what is envisaged is that backstop facility would be an entity which can trade in relatively illiquid investment grade corporate bonds and be readily available in times of stress to buy such bonds from various market participants in the secondary market. This may instill confidence of market participants in corporate bonds, especially in below AAA rated investment grade bonds. SEBI is examining the setting up of such a backstop facility in consultation with various stakeholders. Of course, a broad general guiding principle for any such entity to be set up, the market participants should have skin in the game and the moral hazard problem ought to be satisfactorily addressed. We are aware of that. In the end, some advice to the industry. Though the industry has grown at an outstanding pace over the last few years, reflecting the confidence of investors in mutual funds, there is a need to continue upholding this confidence for the mutual benefit of the industry and the investors it serves. Protecting the interests of investors is the primary duty of mutual funds, and thus all decisions that funds take on behalf of investors should be taken keeping in mind the best interests of investors. The debt mutual funds must remember at all times that there is a difference between investing and lending. Mutual funds are not banks and shouldn't attempt to behave like one. Unlike banks, there are neither capital adequacy requirements for mutual funds, nor do they have the lender of last resort comfort as banks have from RBI. The true reflection of their portfolio and its NAV on daily basis is the cornerstone of transparency and investors' trust. I have been told that 46 mutual funds have over 1,700 schemes. SEBI, in consultation with the industry, had done a mammoth exercise in 2017 and come out with categorization of schemes in 36 categories. Improper categorization of schemes will only lead to confusion amongst the investors, apart from the possibilities of mis-selling. Scheme category and its performance vis-a-vis benchmark are major inputs based on which investors decide whether to invest in a scheme or not. If a scheme portfolio is not true to its label, it might be giving very different risk-return exposure to the unit holders of the scheme than what they have signed up for. SEBI norms for categorization of mutual fund schemes have two objectives: that the scheme portfolio should reflect the name of the scheme, and that the scheme performance can then be compared against an appropriate benchmark. The funds need to keep their scheme portfolios true to their label. While various policy measures have been taken and are being taken to facilitate continuous improvement, the recent experiences have once again shown that there is no alternative to prudent risk management. I hope the industry is able to live up to the expectations of the investors in carrying out its fiduciary responsibility towards them. This is in the interest of the growth of the industry too. I wish AMFI and the mutual fund industry all the best in these challenging times. Thank you.
Sir, with your permission, if you could kindly take a few questions, we'll be very glad, sir. The media is there.
Yeah, sure. But keep it brief, please.
Yeah, we'll keep it brief. So we open the floor to the media for the questions. Please identify yourself and ask the question.
Friends from the media, please raise your hand using the raise hand function. So that we can unmute you to take questions. Sumaira from CNBC, you're unmuted. Please go ahead, ask your question.
Chairman Tyagi, good afternoon, sir. I wanted to ask about this liquidity risk management, the working group that has been constituted. What is the timeline for things like stress testing, swing pricing, etc.? When may they be put into practice? How soon? Thank you.
So this setting of the expert group is under consideration in consultation with the AMFI itself. And we yet to have a definitive timeline, but we'll have it very quickly. And as I said that in the interim, we would be issuing a circular very soon to provide for holding of liquid assets in all debt mutual fund schemes.
Thank you. The next question is from Sajit Mangat from Bloomberg Quint.
Good morning, sir. I have two questions. One is with respect to the fact that you mentioned that mutual funds are not lenders, but yet we have seen in the last couple of months and last year itself, many of the mutual funds are taking the role of a lender and giving moratoriums. What is there going to be a detailed guidelines that you will be coming out for such kind of situations? And the second one is with respect to we saw some of the one mutual fund winding some of its schemes, and it's taking time to pay off its investors. Is there going to be a stricter regime with respect to winding of schemes and payment of payment to the investors?
Yeah, on the first question, what I said and what you also are saying, we are saying the same thing, that there is a clear difference between investing and lending. Mutual funds are not in a capacity to give any forbearance which maybe banks have because of their capital adequacy requirements, and lending is very different from investing. We, in fact, came out with a circular last year, I think in September, if I'm right, where we said that in case mutual funds are extending the tenure of the debt instruments, then we prescribed certain guidelines on the valuation side to disincentivize such arrangements, and we totally agree. And thereafter, in fact, this has been contained to a large extent, these practices, and we in fact keep on emphasizing it. And a lot of improvements in debt mutual funds have come, if I may say, since September 2018 onwards. It has been a gradual journey, because also what has to be seen is that mutual fund has been a very good story, as said by AMFI itself. You have 27 lakh crore AUM as of now. It has progressed very well. So we in fact have been having constant consultations with AMFI and trying to in fact proceed at a speed which market can absorb. On the second question which you said, of a mutual fund winding up, I would only like to note that the matter is sub judice in a court. And so I will not really like to say anything specific on that. But as I said that a lot of improvements in debt mutual fund schemes have taken place from continuously from September 2018 onwards, and thereafter now in the last few months, and the ones which I just mentioned in coming future. So that would certainly make the industry more robust. Thank you.
Thank you, sir.
Thank you. Next question is from Jash Kriplani.
Yes, sir. This is a question pertaining to multi-cap schemes. Sir, could there be a new benchmark for multi-cap schemes given the minimum 25% allocation limit as combined weightage of NSE 500 to both mid and small caps is about 19%?
You see, the multi-cap scheme, the confusion which arose, I would say is unfortunate. What we are saying, and what I also try to address here, is that we are saying true to label. We are saying that if you have 1,700 schemes and they're categorized in 36 categories, each scheme should have a benchmark, and it should, first of all, it should, the form should be as per the name. If it has a name, then form should follow that. And then there should be a benchmark which should be identified, and then vis-a-vis benchmark, what is the performance? And these have been done in consultation with mutual fund industry itself. So when we said that there should be multi-cap, should have some portion in small cap and mid cap, we are not really forcing anyone to invest in those caps. We are saying that if investment should be done in the best interest of the investors. There is no quarrel on that. It's only if you are giving a label, then the scheme should show as to it is the form should be as per the name. Thereafter, we have received a representation from AMFI, and we are actively examining that request, and we'll see how to further clarify this. But intention certainly cannot be of anyone to push for investments which may not be in the best interest of investors. I would leave it at that.
And sir, as a quick follow-up, sir, can a flexi cap category be launched, which can also allow multi-caps to function as they were functioning earlier?
So as I said, that AMFI has made a representation. They have given some suggestions. And till we take a view on that, I won't really want to say that what are those suggestions and what we are doing. But we'll shortly and very quickly examine them. As I said, that AMFI has given a detailed sort of a reasoning as to what they feel should be done.
Thank you, sir.
Thank you. We'll take a few more questions. Next question is from Chiranjeevi from Cogensis.
Good morning, Mr. Chairman. Just wanted to understand, you mentioned that the committee would be examining a backstop facility for corporate bonds. Just wanted to understand what is the idea behind that, and how do you envisage that backstop unit to function as? And secondly, I just wanted your thoughts on basically, recently there was a piece done that showed that, AMFI, of course, has seen over the journey of 25 years that a lot of women fund managers have come up, and SEBI itself has taken a lot of efforts.
Hello.
Yeah, am I audible?
Yeah.
Sorry, yeah, and SEBI itself has taken a lot of efforts to, bring women directors on board at the corporate level. Just wanted to know whether SEBI is also taking efforts to, increase the diversity quotient at its own institution. Because a recent analysis done by us showed that there has not been too much women participation at top level at SEBI, especially at the general manager level. So just wanted your thoughts on that the efforts that SEBI is taking to, increase the diversity question at the institution. Thank you.
So on the first one on backstop, that has not been given to any committee. In fact, we have had some discussions with the industry, and it also has been to MFAC, that Mutual Fund Advisory Committee, and we have had discussions with various stakeholders. So it has not been given to any committee. Committee was something else, which I said. Having said that, what is being thought is also it is, although it is still in thought process, that they in cases of crisis which lead to illiquidity in the bond market, if a facility is created which could then buy those bonds and on a commercial basis, and then use them later and then sell them in the market when the market for that really comes up, or they find other ways of disposing them off. Here, the important things which we are looking for are that there should be skin in the game of the industry, which anyone who wants to take, and there should not be moral hazard. So maybe some sort of a first loss to be taken by the participating market participants, and thereafter the facility coming into being. So this is something which we are working, which should we are still debating on various ways as to what form this entity can take. But we have had discussions at all levels, and we'll take it forward, I believe, in coming future fairly quickly. On the other issue of women directors, you are referring to the requirement mandate for the listed companies, the requirement for women directors. With that, if I heard you right, then you shifted to women's in as a fund managers, and then you shifted to women in SEBI, if I heard you right. So it is a welcome thing. If you have any concrete suggestion AMFI has for increasing that, I mean, it can be like AMCs have boards or trustees are there, whether there can be if AMCs are listed, the mutual funds which are listed naturally will have that requirement. The one which are not listed, there also if there is something can be agreed by AMFI and all, will be very delighted to do that. As far as SEBI is concerned, I think we have a fairly good representation of women officers at all levels. I don't remember the figures, but we are fairly well represented level of women at all levels, and we encourage women officers to we give them all type of engagements and challenging tasks which others have. So we have been fairly encouraging women officers to do well in SEBI. Thank you.
Thank you, sir. Next question is from Jayesh Khilnani of ET Now. Jayesh, you would have got a prompt to unmute yourself. Yeah, go ahead.
Yes. So my question is on in the multi-cap allocation. Now, while it is fair enough where SEBI is saying that, you want to achieve being true to label, and that's why you want to put a cap of 25%. But on the other hand, the industry feedback is that, there is not much liquidity in the broader market space. If we want to achieve this, then there will not be absorption power in that category. So, ultimately, how will the fund manager, allocate if there is no scope to invest, or there is not enough liquidity in the market itself to take that much?
I think I've already replied to the earlier question. I said that we are not telling funds to go and invest which is not in the interest of fund or investors. We're only saying that if you're calling it something, then it should follow like that. And I also said that AMFI has given a detailed representation giving various arguments. And I also said that we'll be taking a view pretty soon. Now, what will that view be and what options, what they are? In fact, AMFI is aware of that. But more than that, I've already clarified what in my address also and thereafter. And I don't know I don't have anything more to say on this. Thank you.
Thank you, sir. We'll take last two questions. Next question is from Mr. Brajesh Kumar from Z. Yeah, Brajesh, please go ahead.
सर ब्रजेश फ्रॉम जी बिजनेस। सर दो सवाल हैं। एक सवाल ये कि आपने कुछ महीने पहले ये कहा था कि जो रिटेल इन्वेस्टर हैं उनके लिए व्यवस्था बनाई जाए कि वो जो सरकारी बॉन्ड हैं सुरक्षित किस्म के, वहां पर वो अपने पैसे लगा पाएं। तो उस पर कोई प्रगति हुई है क्या? आपने एक फिक्की के इवेंट में ये बात कही थी। तो एक तो ये समझना है, और दूसरा ये कि अपफ्रंट मार्जिन को लेकर के रिप्रेजेंटेशंस आपके पास लगातार अभी भी आ रहे हैं, तो उस पर क्या कोई बदलाव करने की आप सोच रहे हैं, या वहां पे कोई रिकंसिडरेशन है कि कुछ किस्म के सौदों में आप ये रियायत दे पाएं?
देखिए, जो पहला प्रश्न है आपका कि रिटेल इन्वेस्टर्स का गवर्नमेंट सिक्योरिटीज़ में ज़्यादा पार्टिसिपेशन रहे, वो हमने उस समय कहा था, और वो हमने इस बारे में निर्णय सरकार को लेना है। हमने जो हमारा सुझाव है हमने सरकार के पक्ष में रखा है कि उसमें क्या आर्गुमेंट्स हो सकते हैं और क्यों इससे रिटेल इन्वेस्टर्स का और जीसेक में और जो इंस्टीट्यूशनल इन्वेस्टर्स के अलावा नॉन इंस्टीट्यूशनल इन्वेस्टर्स और रिटेल इन्वेस्टर्स जो हैं वो और उनकी भी इसमें भागीदारी रहेगी। तो इसलिए हमने सुझाव भारत सरकार को भेजा है, जिसमें उचित निर्णय उन्होंने लेना है। जहाँ तक आपका दूसरा प्रश्न है अपफ्रंट मार्जिन का, ये इसमें काफ़ी विचार के बाद ये किया गया। ये आपको याद होगा, ये सर्कुलर नवंबर 2019 में पहली बार इशू किया गया था, और इसमें जो व्यवस्था है वो इसलिए है कि इसमें जो रिटेल इन्वेस्ट और जो भी इन्वेस्टर्स हैं, इसमें जो इन्वेस्टर्स हैं उनको शुरू में स्किन इन द गेम उनको होना चाहिए। जो उनका फंड्स हैं वो उन्हीं के लिए इस्तेमाल हों, ना कि पूल्ड अकाउंट में फंड्स इस्तेमाल, एक आदमी का फंड्स दूसरे आदमी के लिए इस्तेमाल हों या प्रोप्राइटी के लिए इस्तेमाल हों। तो इसलिए जो हो रहा था उसको रोकने के लिए, और क्योंकि आप देख रहे हैं कि पिछले कुछ समय से जो शिकायतें आ रही हैं ब्रोकरेजेस में जो डिफ़ॉल्ट्स हुए हैं या उससे पहले जो उसमें गलतियां निकली हैं, वो संख्या काफ़ी बढ़ रही थी। और तीसरी बात मैं कहना चाहूँगा, क्योंकि जैसे आपने खुद कहा कि रिटेल पार्टिसिपेशन अब काफ़ी बढ़ गया है। जो डीमैट अकाउंट्स हैं जो जनरली हर महीने लगभग 6 लाख होते थे, वो अभी अगर आप देखें जून के आगे, जून ऑनवर्ड्स, वो 10 लाख से भी ज़्यादा आ रहे हैं। तो रिटेल पार्टिसिपेंट्स जो है पार्टिसिपेशन बढ़ रहा है, और इसलिए ये ज़रूरी है कि इसमें ट्रांसपेरेंसी बढ़ाई जाए, और जो रिटेल इन्वेस्टर्स हैं वो जो हैं जो इन्वेस्टमेंट करें तो सोच समझ के करें। और ये जो दूसरी प्रथा थी कि पावर ऑफ अटॉर्नी के माध्यम से एक बार दे दिया और वो छोड़ दिया ट्रेडिंग मेंबर पे कि वो कहीं भी इन्वेस्ट करें, और हो सकता है उसमें ईज ऑफ कन्वीनियंस रही हो, लेकिन उसमें जो गड़बड़ियां आ रही थी सामने और कई सीरियस गड़बड़ियां सामने आई, उसको देखते हुए ये सोच समझकर ये निर्णय लिया गया है, और ये अब बिल्कुल ठीक चल रहा है। शुरू में इसमें टीथिंग ट्रबल थे, वो भी इसलिए क्योंकि अगस्त के महीने में हमने कहा था कि दोनों सिस्टम चल सकते हैं, लेकिन अगस्त एंड तक वो नए सिस्टम के प्रति किसी ने प्रयास बहुत कम किया, तो इसलिए जो लोड बढ़ गया था क्लियरिंग कॉरपोरेशन और डिपॉजिटरीज पे, उसलिए इसमें शुरू में सितंबर के पहले सप्ताह में कुछ समस्या आई, वो स्टेबलाइज हो गया है। ये सबकी भलाई के लिए है, इसलिए इसमें फिलहाल कोई बदलाव का हम विचार नहीं कर रहे हैं। धन्यवाद।
Thank you, sir. One last question from Malini Gupta of Financial Express.
Hello. Good morning, sir. Thank you so much. I have a question which has often been discussed by industry stakeholders and investors, but nothing seems to have come out of that discussion, which is that mutual fund houses backed by banks seem to have enjoy a disproportionate advantage when it comes to selling their bank partners selling their own funds, and the fee income generated seems to suggest that a large lion's share of the fee income comes from them pushing their own mutual funds. That seems to have been a case for a long time. Industry participants have also raised this issue because it's not an open architecture that these banks seem to follow while pushing funds, mutual funds, which should be ideally based on performance rather than the same family of funds that they are pushing because it's part of their own group. The other is that also EPFO, government also seems to play preferences here. Whether it is EPFO money or PSU money, that also seems to automatically go to SBI funds. Should there not be an open architecture mechanism that should be followed when it comes to investor money, whether it is from the government's provident fund money that is ultimately the savings of an investor? So therefore, the best possible opportunity should be given so that the best returns can be earned on them. Sir, is there something that SEBI plans to do on this?
Yeah, on the first question, if in the same group mutual fund are there and banks are also there, I mean, banks have mutual funds also, and they are making more effort to sell their own group products or mutual funds. That's something, you really cannot stop. I mean, there have been some people in the past saying that you fix a cap that, you cannot sell more than so much of their own mutual funds. That would not be very practical. But if there are mis-selling complaints, as you said that they are trying to mis-sell their own products, that is something which we take quite seriously. In fact, we already segregated investment advisors and the mutual fund distributors' role through our regulations, which are very elaborate. They apply to the institutions and individuals, including the banks. So if there is a violation of those regulations, we would be proceeding and taking action. But prescribing a cap or something that a particular bank should sell only that much of percentage of its own mutual funds is not something which will be practical. On the second issue, we agree that there is some sort of a communication that PSUs should invest, or even EPFO perhaps should invest in only the mutual funds which are owned by banks, PSU banks. So we already have addressed to the government, and we agree that mutual funds of any categories, so long as they are registered with SEBI and regulated by SEBI, it shouldn't go by the ownership of the mutual fund, whether it is owned by a PSU bank or a private bank or any other entity, non-bank also. So we already taken up with the government suggesting that should be amended, and they should be free to invest in any mutual fund which are regulated by SEBI. And then they can take a view of their performance vis-a-vis their benchmark and decide such investments. So I agree with you on that. Thank you.
Respected Chairman, thank you for coming over here and giving you a valedictory address in our 25th AGM, which is a very, very momentous occasion for AMFI. Amidst your busy schedule, you took the time out. We are deeply indebted to you for that. SEBI has always been giving us good encouragement, support, and guidance.
Okay, that was a very extensive note by Ajay Tyagi, the SEBI Chairman. It seems that the MF industry has weathered the storm pretty well. Fundraising via capital markets during this fiscal year is positive, and several measures have been taken to bring calmness to the markets, which are yielding fruitful results.